You are live. It says we're
Yep.
live, but I don't see us on screen, so I'm hoping we're on screen. Do you see us on screen?
I do. I do. I
You
think we're
do.
good now.
Okay. Well, apparently we're live. I can't see what we're talking about or see us side by side, but welcome everybody to our show. I'm Lisa Wickman. This is the Biz Chat with Lisa, and I'm here with Jerrad Havins of Credit Life. And today we're going to talk about some credit and financial wellness. So, Jerrad, welcome to the Biz Chat. Thank you
Yeah.
for joining us and being my first guest after a long hiatus. I'm happy that you are here. Can you introduce yourself a little bit? Tell us about yourself, your background, and what Credit Life is all about.
Yeah. Yeah. Definitely. So I'm Jerrad Havins, CEO of Credit Life, also known as a financial freedom strategist. One thing that we say at Credit Life that we all live by here is we say Credit Life, which is inspiring financial wellness. And so when we started this is back actually 10 years ago now. We actually over 10 years. In the very beginning, we started out as a credit repair organization. That was our start.
Yep.
And what we found over time is that, and if anyone's gone through credit repair, some people have, a lot of people haven't, but maybe they've heard about it. A lot of times companies out there, there's a lot of companies, but like they really just kind of hone in on just that aspect of the service, which is repairing negative items off of credit reports. But
Right.
what we found is a lot of people, they need more than that. They just do. They need help with understanding, how do I pay down debt? How do I settle debt? How do I get approved for a mortgage? How do I get approved for a business loan? Like, what does this actually mean? How does my credit scores work? Like, they need more. And so with that, as we grew as a company and we identified this, that's what Credit Life became. And that's why I would say about maybe 7 years ago now is when we said inspiring financial wellness, because we took more of a holistic approach to our service to really work on repairing the past, effectively building their credit, and
Yep.
on top of that, understanding how to manage their debt and their finances in a way to really put them in the best position possible moving forward for their goals.
Oh, that's great because you're right. It isn't just about credit repair. It's the whole thing.
It is. I
Yeah.
mean, we talked about it this morning before we got on. It's like a lot of times repair is a band-aid. But
Hmm.
if you're in a situation where it's like, I have a cut that's bleeding and I need it to stop, a band-aid may not work, right? We may need to do surgery here. We need to like stitch that bad boy up.
Yeah.
That's what we're doing here. It's like, look, we're identifying a problem and understanding like what is this, and legitimately fixing it. And that's important to us because we want our clients to be able to move forward on their own after the program. We're not here for repeat business. It's more like, hey, let's really work on all these pieces so that way you're set for the future. And that's what really sets us apart. And it's a lot of work, but we love it, myself included. I love it every day, but my team's the same way. We're all the same way. We care about our clients, and we're always looking at like, what else can we be doing to help them? So it's a very unique, we're in a unique industry. There's not a lot like us, especially the way that we approach it. It's
Hmm.
rare.
How many people are on your team, by the way?
Right now we're a total of 9.
Total of 9.
Yep.
And are all of these people working in the credit repair aspect of everything, clearing debt, doing whatever the case may be?
Yeah, it's like set up in different divisions. So we have a team that handles the investigation aspect, which is the credit repair piece, which is a
Okay.
done for you service. So clients that need credit repair services, I have a team here that they will be the one to directly facilitate that on behalf of the client. And then we have our coaching division. And so that's with FICO certified coaches, which is another thing that's rare to come by, is actually we're certified in the algorithm that makes up your credit score within FICO.
Wow.
Yeah,
FICO or coaching services. Is-
exactly.
Really? I never
Yeah,
even
and that,
heard of that.
yep. And what's crazy about that, Lisa, is that we did this probably about 8 years ago, around 8 to 10 years ago.
Yeah.
And All Regs Academy provided this class. It was a phenomenal class to become FICO certified. This is done through FICO. And apparently there wasn't enough demand for it, which blows my mind because they got rid of it, which that it's
Oh,
the
no.
amount of, this FICO and credit impacts like so much now.
So much
Lending,
employment.
employment,
I mean,
exactly.
yeah.
Yes, and so it's no longer in existence. So I'm very thankful that we went through that. We did that obviously to enhance our expertise and our knowledge.
Right.
But yeah, it's going to be hard to find a FICO certified coach like we have here. We have a total of 5 on staff.
That's very interesting. Very interesting. I didn't know that. Okay. So I want to talk a little bit about the current financial reality of consumers. So let's talk about what's going on with people right now.
Yeah, I'm excited to talk about this, just because we experience this every single day. We've seen this with our clients. We've actually seen the progression with our clients over the years. On top of that, the type of clients reaching out to us and what their challenges are. And I would say the biggest issue that we've identified, it's out there in the news as well, so it's not like it's going to be a surprise, but it's going to be credit card debt. The amount of debt that we've seen on average, the utilization ratios, which is what is my balance versus the limit. We've
Yep.
seen a great increase of people carrying higher balances, which is higher utilization, and it's dramatic. It really is. It's we've seen, like, to give you an example, I would say about maybe 7 years ago, when a client would come to us, typically we'd see a few $1,000s in credit card debt. They may have some like collections from their past that might range between 2 to 8 grand in collections that need to be figured out. Maybe some late payment history because they went through an event in their life like a divorce or medical issue, job loss. Like, typically something happened to that person that led to the bad credit.
Sure.
But really, we'd see a few $1,000s usually on average when it comes to credit card debt. Fast forward to today, we're seeing clients coming in with 20,000, 50,000, 80,000. I mean, it's dramatically increased the amount of
That's
what we're seeing coming through the door
in a short period of time.
in a matter of just a few years. It just changed. I would say COVID on, it just went up and up and up and up and up.
Do you have anything that you attribute that to? Or
I
like,
would
I'm curious if you have an opinion on that.
Oh, I definitely do. I think that when I just think about this type of stuff, I know there's people out there on the news outlet, they talk about the statistics and analytics of things. I like to look at human nature. And
Mhm.
the reality is what's happened is, basically ever since COVID, we've seen a dramatic increase in interest rates.
Yeah.
We've seen the cost of living go up dramatically when it comes to groceries. You remember
Yeah.
the whole thing around eggs for a long time there. I
Oh,
mean,
yeah.
all these different things.
Oh,
The
yeah.
cost of living itself just legitimately has gone up. And then on top of that, if you look at like a trended history, a lot of times companies that provide products and or services usually do a price increase the first quarter of every year. So like we've just seen an increase in just overall cost of living year over year, now going into 2026. And then if you think about that, a lot of times human nature, that's what makes credit cards so dangerous, is people view it as an extension of income when it's
Oh
not.
my.
That's what's
Wow.
happening because they it's just so easy to use and they have an available limit and it's so easy to swipe. And in their mind, because I've heard clients tell me this, they say, I knew that I wanted this thing, I just got it, and I figured, hey, I get paid on this date and then I'll pay it off then. The problem is with that type of mindset, the pay date comes, vast majority do not pay that off. Maybe
Sure.
they paid down a minimum payment or a portion of the balance, but incrementally, if I'm saying that correctly, sorry,
You are.
the balances just go up and up. And then if you think about the high interest, on average 27 to 29%, before
Right.
you know it, that balance just continues to go up. And this is where people get in the trap. This is it right now, because you have these minimum payments at first with lower balances, they're very low, right? It might be between $15 to $41 a month.
Okay.
But as that balance just continues to go up, whether it be because of the interest compounding or continued use to higher balances,
Yep.
now all of a sudden, before you know it, you have a minimum payment of 150. But now that's spread across maybe 7 cards. And if you think about how easy it is to get into this trap of not only high balances, but now your monthly expense just to maintain your minimum payments on your credit cards has become significant in your overall budget. And so that's the issue. It's increased cost of living. It's the mindset of looking at credit cards as an extension of income, and they get caught in this trap. And before they know it, they're looking at this going like, I can't even afford this anymore. I don't know
Right.
what's going on. I'm beyond paycheck to paycheck, regardless of their income, because people do have a tendency to level up their lifestyle based on income. So their situation is actually quite similar when it comes to their overall budget and what they can afford. It's just that the figures are higher.
And then do you think that people bury their heads in the sand
Oh,
about
without a
this?
doubt. Yeah. Yeah, I would say that, realistically, people bury themselves in the sand, their head in the sand. And here's another thing that I found. Once again, I'm all about human nature. I'm
Yeah.
fascinated by this because I've gone through it personally. I get it. I would say guys specifically have a tendency to think, I'm just going to work more, I'll just make more money, and that'll fix this. That's
Okay.
that's
That's the
typically
male
going to be
perspective.
that's a male perspective. I would say 9 times out of 10. I'm just going to work harder. I'm just going to make more money, and then I'll fix it that way. But what you need to do is just do an actual analysis of like what's going on. And honestly, it's spending habits. That's the number one thing to look at, and really look at it. Like, what are my spending habits? And the best way to do that is you have to go back and look at all your credit card statements, bank statements. Did you pull out cash? What was it used for? Like, you really got to go back and look and be like, where did my money go? And then why is it that I continue to use credit cards? And you have to reverse engineer that. This is what we do with our clients all the time. Like, really understand like what's going on here, through a coaching session if they request this type of coaching session. And it's like, okay, what needs to be done? We need to figure that out first. Like, what is the root cause, the root problem? And then from there, we can reverse engineer and figure out solutions. That is the first step.
And I'm assuming that most of the people that are coming to you are looking for a home or want to buy a home.
Yeah, I would say they either want to buy a home, they're looking to get approved for a mortgage,
Yeah.
or it's a business owner looking to acquire more capital for their business. Those are the top two right now.
Well, a lot of businesses are. So then, because I know this, because I'm a business owner, right? And I have two businesses, and business credit is different than personal credit. So these business owners that are coming to you, is it because their business is in debt, or is it because they have a personal guarantee on that, or
Yeah,
what
it's
is
a
that?
mixture. So in most cases with business owners, when they're reaching out, it's usually a mixture of, one, they've been leveraging personal credit cards for business purposes. That's
Done that,
very common.
been there for
Yep.
sure.
It's extremely common.
Yep.
And so that's number one. And then usually what it comes down to is like, look, my business, maybe they're a newer business or they're established business and they're looking to grow. And what they find is that when they're going to like a traditional bank to acquire capital, to get a loan, traditional banks are just naturally going to always be more conservative.
Sure.
And your personal credit, even though business credit exists, which we can talk about that, personal credit is still number one.
It is.
It just is. And so when you think about what we're discussing now, credit card utilization and balances, if you're a business owner where you're finding yourself having to use your personal credit cards for business transactions, business purposes, well, now your ratios, your balances are increasing,
Right.
your utilization ratios increase. Now your FICO score is plummeting. It's just dropping.
Right.
And so then they go to the bank going like, I need to loan. I need to create separation here. Like, I need more. Well, the problem is they're going to look and see, one, your scores are low. And then on top of that, your utilization is high, which is a flag for underwriting. It's high risk. So
Right.
they've just put themselves in a position where it's going to be difficult to get approved for a loan through traditional banks. And so like what we'll do there is we'll kind of analyze what can we do to improve FICO credit scores. That's number one. And then like, let's say we're missing the benchmark a little bit. We'll create a plan on exactly what we got to do to hit that benchmark for that score. And then we'll move towards like, okay, now we can start getting access to capital. One of the best things to do there is when we have the scores ready is looking at like a business credit card at 0%.
Yeah.
So we can begin to move those transactions that you were using personal credit cards for to a business credit card that does not report on the personal credit, reports on the business. And now we can work on getting ratios down further, but now we're moving everything over. And this does not report, your business credit cards do not report to your personal credit. So we have that separation. And now we're improving the overall strength of the bankability of that business. And then we can look at an SBA loan, a term loan, a business line of credit. Like, so we're always analyzing like what's the best route to get them not only get approved for the best loans, the best lending terms, but doing it effectively and properly so that way they can get out of this trap that they're faced with.
Okay. So I have a couple basic questions. I mean, I know the answers to these, but let's talk about debt to income ratio and how that affects your score. I mean, I know it affects your score, but in my from my knowledge, you want to keep that debt to income ratio under 30%.
Yeah. So there's a difference, like debt to income versus like debt to balance,
Debt to
utilization
balance,
ratio.
that's what I meant. Debt
Yeah.
to balance on your
Yeah. Where
credit.
debt to income ratio definitely plays a big role as well
Yeah.
for underwriting, not the score, but
Yeah.
for utilization. I'm glad you brought this up because I don't know when, why, or how this became so popular. 30% is like that golden rule that people always talk about. Like, hey, Carrie,
Right.
don't go above 30% on your credit cards. Or people get confused
Explain
thinking,
what that means, because I don't know if everybody would know what that means.
oh, it's okay, that's good. So like what that means is, here's the best thing. If you're watching this right now, go to your credit card statement, get your most recent billing statement. And then what you're going to do is you're going to look at on that statement, it's going to reflect what the balance was at the time that they generated the statement, what your limit is, what your minimum payment is. Those are the three key things, right?
Yep.
But what you're going to find, usually in like the upper right middle area of the statement, is what's called a statement closing date or a billing cycle end date. And so what that means is it's usually about 3 weeks prior to your due date is when they generate your statement.
Yep.
So on that statement, whatever that balance is compared to the limit, that is the utilization ratio that is going to report on your credit report.
Mm-hmm.
It's that. So let's say it's $1,000 limit and the balance is $500. It's going to be a 50% utilization. Even if they paid it off in full by the due date, it is going to report a 50% utilization because it's the statement itself. When that statement is generated, that's what's sent to the credit bureaus, not your payments.
Not okay. All right, I got it.
Yeah. So this is another thing, like with business owners, if they're using personal credit cards for business purposes, a lot of times they are making big payments on it because they're using it often.
Right.
But they don't know what we just discussed. They don't know that that statement is what was reported to the credit bureaus. That's how it shows up on the credit reports. So in their mind, they're thinking, hey, I'm using this, I'm paying it down, I'm using this, I'm paying it down, this is good. Well, not if the ratios are high. If you're maxing it out, even if you pay it off in full, it doesn't matter. It's going to show maxed out and your scores are in the tank.
Okay, that is a lesson because I did not know that. I just figured what everybody else was thinking, that if I paid it off every month, I'm golden.
Yep. And with credit cards, that's not the case.
That is
Yeah,
not.
exactly.
Okay, that's very interesting. Okay, what else do we want to talk about? Well, why it's a serious problem. I mean, it is a serious problem.
It's a massive problem. I mean, and I mean, there's a lot of news, there's things around the administration proposing, a reduction in interest on credit cards, capping them, I believe, at 10%. We'll see if that happens or not. I mean, that would be, honestly,
amazing.
That would be a legitimate relief for a lot of people because the balances we're at an all-time high.
Yeah.
Credit card balances as a nation. So it just shows you that there are a lot of people. So if you're watching this and you're dealing with that, trust me, many others are as well.
I'm dealing with that. You talk about life events. I mean, I've had a life event with taking care of sick, deaf, and dying parents and things like that, where I was not really able to work very well. Mental health issues came in with that. But
stressed out and everything that comes with that.
And so unfortunately, I'll be honest, I have some high credit card debt because of life events, and I'm working on getting that taken care of.
Yep.
But I know I'm not. There's a plethora of people out there who are in the same situation.
And what they're facing, and because we hear this, and I get it. It is stressful. Like when you think about it, like financial stress not only is unhealthy for you in general, because stress itself is unhealthy for your body.
Right.
If you're in a relationship, let's say you have a family, financial stress is one of the leading causes of divorce.
Right.
Like it just naturally brings on, like if you think about it, when you're operating under stress like that on a daily basis, you just naturally perceive life differently. It's going to be in a typically more of a negative lens, like you're always behind the 8 ball.
Kind of a cloud hanging over your head.
Yeah, and it's like it's always there. It's weighing you down. You're worried about it. And the issue is because when you're feeling that way, it's because you don't have a solution. You don't have a plan. You're kind of winging it in a way. Like, I'm going to keep working. I'm going to keep going. I just got to keep going, which is it's good to have that type of resiliency built into you, but you need to have a plan to know, like, how do I actually get out of this? And so for us, like one of the biggest thing, if I have someone where it's like that is a main, concern is credit card balances and how do I reduce this? There's a few ways you can go about it. So we talked about number one, and I help clients do this in a one-on-one session. Usually it takes more than one. It's like a few, where the very first step is an analysis of spending habits. Where is the money going? That's number one.
Okay.
We got to figure that out. We have to, because if
Yeah.
we don't, we're leaving too much gray area, and we're putting ourselves at a disservice to not hit our goal. So we have to figure it out and just know with clarity, like, where's our money going? Once we have that figured out, then we can identify, and I just view them as like brackets of category expenses, like different brackets. And if there's one that we have more control over, well, we should analyze that. Like, what's the lifestyle looking like? How often are we going out to eat? How often are you getting DoorDash and all the different things and going to Starbucks and whatever? And I'm not an advocate of, because there's like Dave Ramsey out there, like pay off all debt, there's like no debt at all. I'm not an advocate of that. What I'm an advocate of is understanding your habits, and let's create realistic benchmarks of improvement over time. Because like the way most people operate is like when you see some improvement, you just naturally get more excited, like, oh, this is working. Okay, I'm going to keep going then. I like this. But if you make like a massive dramatic change overnight, the vast majority of people can't stick to that, and they just go right back to their old habits because it was too much.
Yeah.
So it's like I like to take that approach into building out this plan where it's like, okay, do you think we can bring this down? Like, let's say, easy number, I'm spending $1,000 a month going out to eat all the time. Okay, I mean that's a lot, but let's just keep numbers easy.
Yeah.
Well, it's like, okay, well, realistically, could you go to the grocery store a little bit more and do more home cooked meals? And like, let's see if we can bring that number down to maybe 700. Well, now I've just freed up $300 that can be used in a debt reduction plan. You know what I mean? Like, and so if we make these almost like micro adjustments to our spending habits, we can monitor that and see, okay, now we've increased available cash that we can begin to use for debt reduction. And then, so that's the next step, is creating a debt reduction plan, which then from there, we analyze all the different debts. And what I like to look at is a few things. One, the interest rate is a given and on it, the balance, the minimum payment, so we can kind of see ranking a priority of what should we get out done first. But here's a big one that a lot of people overlook and it's not talked about often. How long, like what's the length of credit history associated to that credit card? A lot of people don't know that the longer the card has been opened or established, as you bring the balance down on that one, your scores go up faster. So like, let's say I have a card so like, let's say I had a card that you opened up 10 years ago, and we have one that we opened up a year ago, and they both have like, they're almost maxed out. Well, if I begin to pay down the one that was opened up 10 years ago, your scores improve faster.
Because of the longevity of the card.
Because of the length of credit history associated to that card.
Okay.
And the reason why that's important is, yeah, and a lot of people, like, they overlook that. It's not talked about enough. It's just not. And
I've never heard it.
And what we can do is like, okay, well, let's create a debt reduction plan, but then can we implement, as scores go up, a lending instrument to help us pay down the debt faster and reduce interest? Because a lot of people, what they'll try to do is go get a loan to pay off debt, but if they have maxed out cards, they're going to get denied. So that's where this comes into play. It's like reducing debt strategically, so we save on interest, we save money, we do it effectively and as quickly as possible. But then we can bring in other things like that. I was talking about the loan at the appropriate time, and that's another solution. So like there's a lot of solutions available is what I'm trying to say, and that's why the plan is so important for someone. They don't know these things, and so that will bring clarity. And if someone understands it, and it's like they get it, like, oh my goodness, I see what you're talking about, I can do this, that's when they're going to win. It's otherwise they're just operating, like you said, a fog. They just don't know, and they're kind of just living and going through the motions.
Yeah. Well, I've been living it and going through some motions for a while.
It's easy to do.
But I wanted to say, when you were talking about making these micro goals and going, your partner Rick referred one of your clients to me to help her find a house, and she's so excited, just super excited about being able to buy a house, because she didn't think she was going to be able to buy a house, and she will. She's not ready yet, but she'll be ready in a few months.
Yep.
And that is something, a great goal to be looking forward to. So, well, we need to wrap up pretty quick, but I want to ask you, where can people find you? We'll post some things in the comments.
Okay.
And if you want to shout out your phone number, feel free.
Yeah.
Where people can reach you, go
Yeah.
for it.
I'm old school, so the phone number is perfect. I like the phone and text. So my direct line is 612-444-3426, which is actually FICO. So
Okay.
612-444-FICO
Okay.
is my direct line. And our website is creditlife.com. So it's CREDILIFE.com. It's credit and life mixed in one. Remove the T. Boom. That's Credit Life. That's what we're doing, is empowering people to change their life, their credit and financial wellness. And that's the best way to reach out to myself and my team. It's a full team here. Just so everyone's aware, I'm involved in all of it. And so a lot of times, like when you reach out, you'll get connected with a FICO certified coach. You're going to have a no cost consultation so we can figure out exactly what's going on, what are the best solutions. And then from there, you'll be able to make a decision like, yes, this sounds good, let's get started. And then from there, you have an assigned coach. I'm involved all the time. I get pulled in on things for overall strategy purposes. We have our team that helps with the repair piece. We have a coaching. We have all this in place. So you're anyone that comes to us, they're fully supported. That's what's so important to understand. They're supported.
They're supported. Well, and I've seen it firsthand. So we are going to be meeting with Jerrad once a month. He's going to come on the first Tuesday of every month, and we're going to talk more about financial wellness, credit repair, so that you can maybe get towards living the life you want to live. So thank you for being on here. Yeah. I really appreciate it. And I will see you again. And thank you for watching.
Thank you.
Bye, Jerrad.